Have you ever wondered which business structure is best for your startup? Well, here's an interesting stat. About 70% are set up incorrectly. So I'm going to be talking today about LLCs, S corporations, and C corps as different business structures commonly used by entrepreneurs and startups. Deciding can be stressful and messing it up can be costly. So you want to make sure you're making the best choice. Choosing the wrong entity can cost you tens of thousands of dollars each year in excess taxes. Choosing the wrong entity can literally be the difference between success and failure in your investing in business. Whether it's taxes, asset protection, operations, all need to be addressed. So that is what I'm going to do for you. Here are the key differences between LLCs, S corporations, and C corps to help you decide. And if you could do me one huge favor, please like and subscribe. If you hate the video afterwards, feel free to unlike it. But hopefully you'll see the value in what I'm doing, so let's dive in. Number one, let's talk about taxation. LLCs, first off, we're going to compare LLC, S Corp, C Corp. So by default, LLCs are taxed as pass-through entities, meaning the profits and losses are going to be passed through to the owner's personal returns. If you have more than one owner, it's going to be a partnership. If it's a single owner, it's going to be considered disregarded. So if you ever hear the term disregarded entity, what they're really talking about is an LLC that is ignored for tax purposes. In other words, the owner is reporting everything on their personal return. But they're also very versatile. You can make them into an S Corp and a C Corp as well for tax purposes. LLCs are basically a Swiss Army knife of business entities. You get to choose how it's going to be taxed. You tell the IRS, here is how my entity is taxed. That's why so many practitioners love them, because they are so versatile. So to review, I could have an LLC that is ignored and it's just me. I could be a sole proprietor running a business with an LLC that does not file a tax return. It flows onto my personal tax return on my Schedule C. If me and somebody else are together in a business, then we're going to be filing a partnership return for that LLC, and it's going to give me a K-1 showing here's what portion of profits or losses flow down to me, and my buddy, it's going to give him or her a K-1 showing that portion of the profits. I could make an LLC taxed as an S Corp. I could make my LLC taxed as a C Corp, in which case it'll file the appropriate tax form as though that LLC is actually an S Corp, or as though it is actually a C Corp. So let's dive into those next two to make sure you understand the difference from a tax perspective. Number one, S Corps. S corporations are also pass-through entities, but they must elect this status by filing Form 2553 with the IRS. All corporations start as C Corps when they start, and you must elect to be treated as an S Corp. Those profits flow down to the shareholders of the S Corp. So those are the owners of that S Corp. They're called shareholders. Let me contrast that real quick, because LLCs, the owners are called members. So if you ever see that change of, you could have an LLC taxed as an S Corp, they're going to call it a shareholder when we're talking about taxes, because that's how it's treated. If it's an S Corp, just proper, regular corporation, taxed as an S Corp, shareholders, but the profits flow down to the owners. The C corporation is very different by contrast. In a C corporation, you have a flat tax, currently 21% on profits, and the corporate, basically that's called the corporate tax rate. If it takes the profits, so let's say a corporation makes $100,000 and it gets a flat 21%. It means I pay the federal government 21%. There may be state taxes as well, but I'm just talking federal tax for right now. It's taxed at that flat 21%, so there's $79,000 left, and then it pays it to its shareholders. The shareholders are taxed again on the dividends they receive. They get a double tax. That's why accountants freak out when you hear about C corporations. However, most people are zeroing out those C corps, right? But if they do issue out dividends, quite often you're no worse off, because you had a 21% flat tax, and then you have a dividend tax which is at 0, 15, or 20% in the United States. So the way you're taxed, you could be zero tax on those dividends. In other words, it makes really not much of a big difference. So what are the biggest tax differences between the three? LLCs, S Corps, C Corps. Number one, and this is huge, C corporations can reimburse their shareholders, their employees, 100% of expenses for health, dental, and vision. Not misstating that. So if you own a C Corp, you have a closely held C Corp, yourself, spouse, maybe your kids, 100% of your expenses, that corporation, or your medical, dental, and vision expenses, 100% could be reimbursed out of the corporation. It writes a check to you, it deducts that, and you don't have to recognize it as income. That's a huge benefit, especially if you have somebody that you're caring for that's your dependent or yourself that has considerable health expenses, dental expenses, vision. Even long-term care can kick in. That's why those C corporations are so potent. It's the only one that could do that. I don't want to mislead you. An LLC taxed as a C corporation can do that too, but it needs an 1120, which is the tax form that C Corp files. That's one of the major benefits. The other thing that applies only to corporations and not to LLC taxed as corporations, and it is going to be for corporations, S or C, is what's called a 1244 stock loss. It's only corporations because it specifically says stock, whereas LLCs have membership interests, right? So LLCs don't get this benefit, but what it means is, for example, if you have a C Corp that loses money, and let's say it has $50,000 of losses, and I dissolve the corporation, normally that $50,000 would be considered a capital loss, and those capital losses could only be used to offset capital gains. But in the case of a 1244 stock loss, I can actually treat it as an ordinary loss and use it to offset my salary, my wages, or other income. So that's a pretty big benefit. Now let's talk about ownership and shareholders. So we mentioned this earlier, and I'm going to go over it again. LLCs are owned by members. Members can be individuals, corporations, or other LLCs or entities. There's no restriction on the number of members or who can be a member. Let's compare and contrast that to S corporations. S corporations have shareholders, but they are limited to 100 shareholders who must be U.S. citizens or U.S. residents, and there can be only one class of stock. So there are some serious restrictions. A C corporation cannot own an S Corp. You invalidate. If there is something or somebody who owns an S Corp and they are not qualified, that S corporation status is terminated and it immediately is treated as a C corporation from the date that actually occurred. So if you have a C corporation shareholder in an S Corp, unbeknownst to you, somebody transferred shares because your bylaws didn't cover it, or somebody didn't realize that there was a tax implication, you just lost your S status. And no longer is it a flow through, but now it's going to be subject to corporate taxation, and it's also going to be subject to those dividends if you're distributing the profits. Now a C corporation, contrast it to this S, you can have an unlimited number of shareholders and there can be multiple classes of stock. For example, common and preferred. Huge difference, right, between S and C, which is why people, when they go public, you never see them go public in an S Corp, because we cannot have more than 100 shareholders in an S Corp, and we cannot have non-residents, we can't have entities other than perhaps like a living trust. There's a few exceptions, but there are lots of things that will void out that S selection and cause it to be a C. So they just go to the C right away. How about management? Again, LLC, S Corp, C Corp. Well, an LLC can be managed by its members. It's called member managed. It's something you elect when you file it. Or it could be managed by managers, appointed managers. That is called manager managed. And that manager could be another entity. It could be an individual. But you actually have quite a bit of flexibility. That's why people love those S Corps. They're just, or the LLCs, because they're so easy to work with. But you do make that decision when you're filing the entity. So you want to make sure that you're talking to somebody who knows what they're doing, because that election will actually have an impact as you go forward. How about the S corporation? Well, S corporations are generally managed by directors who are elected by shareholders, and there are officers who are appointed by the directors. Typically looks like this. If there's 3 stack, shareholders vote on directors, directors vote on officers. Now, what if I have an LLC taxed as an S corp? Then you're going to have the managers deciding. You could still have a board if you want, but it does become a little bit more loosey-goosey. From a tax standpoint, you're following the IRS rules. From a state standpoint, you're following the LLC rules. When you just have a plain vanilla S corp, it's a corporation that is actually filed as an S corp that's a corporation. It makes it a little more simple, a little bit easier for people to understand because it's treated as a corporation where you have shareholders who vote on directors, and directors oversee the business, and they elect the officers who handle day-to-day activities. Go to the C corporation, it's treated the same way as that S corporation. It has a board of directors who are elected by the shareholders, who oversee the officers, who are appointed by the board. Now here's a huge one: profit sharing and dividends. All right, LLC. Profits and losses are taxed in accordance with how that LLC has elected to be taxed. If an LLC elected to be treated as an S corp, then it's treated the same as an S corp. If it elects to be treated as a sole proprietor, it's treated as a sole proprietor. If it elects to be treated as a C corp, treat it as a C corp. You got it? If an LLC says, I want to be a partnership, then it's filing a 1065, and it is filing the same report that a regular general partnership files. So for the IRS purposes, they don't really look at that LLC. They go like this, and you tell them, here's what it is, and you file the appropriate form. So when it has profits and losses, it's going to be dictated by that form that it's elected to be treated as. Now, S corporations, this is huge, guys. I want you to pay attention. S corporations pass their profits and losses to the shareholders based on their percentages. It has to be equivalent. We can't do any non-pro rata distributions. But here's the big one. Profits are not subject to employment taxes. I'm going to repeat that. Profits are not subject to employment taxes. What are employment taxes? Social Security taxes. Old age, disability, and survivors is 12.4%. Medicare is 2.9. There's an additional 0.8 that comes along, and that old age, disability, and survivors insurance starts to phase out about $170,000. It's indexed for inflation, so every year that changes. But it's a big tax. Let me put it to you this way. If you make $100,000 of profit and it flows through to you as a sole proprietor, you are paying essentially 15.3% on that money. There's a slight discount deduction for part of those, so it ends up being closer to 14.1%. But let's just put this, $100,000, there's $14,100 of tax, whereas if that $100,000 had flowed through an S corp, there would be zero of that tax. You still have your federal income tax, but we can avoid the employment taxes. So all of you out there who are acting as a sole proprietor, you really want to look at and see whether you can avoid those employment taxes. As a general rule, what we like to see is about 1/3 of the profits paid as salaries to the officers. And that goes down the more you make. So if you make $100,000, you may pay yourself a $30,000 salary, which means $70,000 of profit is not subject to 14% tax. It's going to save you around 10 grand. If you make $1 million, you may pay yourself less profit, or excuse me, less wage. You may pay yourself $100,000 of reasonable wage, and you have $900,000 that flows through and is not subject to those employment taxes. It can be a major difference. Well, what about the C corporation? Well, the cool thing about a C corporation is those profits can be retained inside the corporation. In other words, when a corporation has profits, it's taxed at a flat 21%, but it could just stay in there. If you need to get it out to the shareholders, then you try to do so through tax-free reimbursements or fringe benefits. There's a whole bunch of them. I mentioned medical, but there's anything with an accountable plan. We could be reimbursing things like computers, cell phones, meals, travel, equipment, even administrative office in your home, vehicle reimbursement. There's all sorts of things that corporations can reimburse that make a huge difference to lowering that taxable income. But if there is profit, it's going to be taxed at 21%. And if you decide, hey, I want to distribute that profit out to the shareholders, then you're taxed at the dividend rates. And those dividend rates are taxed as long-term capital gains when it's a qualified dividend. A U.S. company giving you dividends, so especially your company, I have a C Corp or I have an LLC taxed as a C Corp, and it pays, let's say, $100,000 of profit, pays 21%, now there's $79,000, and it hands it out to the shareholders. Those shareholders are taxed at their long-term capital gains rate. So it might be 0, might be 15%, might be 20%, but they're going to pay a dividend tax when they receive it. It's not, when you do the math, if you're in the highest tax bracket, it really makes no difference. So it's not catastrophic, but it is something you want to take a look at. And especially when you start comparing that C Corp, the extra tax benefits you get on some of those fringe benefits, and you're contrasting it with, but there's a potential of a double tax, or just leave it in the flipping corporation, right? You need those funds to continue to grow. You're going to find justification for using it. You just pay the 21% and move on. If you're in a high tax bracket, this may be great. Now, what about corporate formalities and regulations? Again, LLC, S Corp, C Corp. LLCs are creatures of state law. And so the state statutes typically have less formalities and paperwork requirements than corporations. That's why people say, oh, LLCs are easier to operate. But here's the thing. From a federal tax standpoint, it's identical to the corporations. They have identical bookkeeping, record keeping, and tax filing requirements as corporations on the federal level. So when you hear people talk about LLCs have less formalities, they're talking about with the state. And here's why. Because LLCs have members and managers. That's it. Corporations have shareholders, directors, and officers. Oh, it's not a big deal. You might have one extra meeting a year for that S Corp. You might have it at the same time. In other words, they say, oh, there's less formalities. It may make zero difference. In other words, it may make no difference to that business and its operations because there's less formality to the LLC. In other words, to me, it's kind of a red herring. I always look at it saying you should treat all businesses fairly identical from a tax standpoint for sure. But from just how you operate it, I'm always going to shoot up here. And so even if an LLC has less formalities, I'm still going to treat it like the business it is and treat it with respect because I want the courts to treat it with respect. Great judge that I used to clerk for said, I will treat it with the same amount of respect that you treated it with. If you treated your business with disrespect and ignored a bunch of things, then I'm going to treat it with disrespect and ignore a bunch of things, right? Makes sense? So treat your business as a separate business. Now, S corporations must adhere to specific IRS requirements to maintain that S corporation status. Those requirements such as a limited number of shareholders and one class of stock and limitations on who can be shareholders. It has to meet those or it gets tossed over back to a C Corp. And it files a tax return called an 1120-S. Now remember, in the very beginning I said an S corporation comes into existence when we file a 2553. It's called an S election. It's automatically revoked if you miss one of the requirements, right? Hey, I have a C corporation shareholder and an S corp. No longer is an S corp. It's revoked. It's at 1120. So that's just something to remember. Those S corporations are a little more temperamental, and you want to make sure you have somebody on your team that's knowledgeable so you don't step on a landmine and unintentionally cause yourself to have double taxation that you didn't anticipate and could be a nasty surprise some 2 years later, right? When you're getting audited and you go, oh, nuts, I had no idea. And then they say, by the way, all those profits that you took out of that S corp, we're going to double tax. It could be a negative situation. So you want to make sure you have somebody on your team that understands this. Now, C corporations, they're generally subject to more regulatory requirements, including, hey, it has to do annual meetings, record keeping, compliance with the state, and it also files an 1120. When you see companies go public, you're adding another layer of complexity. You have the SEC, and it's filing a bunch more reports that it's required to to have a bunch of investors. But for the state standpoint, not too bad. You have a shareholders meeting and a directors meeting every year. And remember, you can have an LLC taxed as that C Corp. From a federal tax standpoint, it's got its own tax bracket, that 21%. An LLC can be treated identically, which is great. Here's another benefit of an 1120 or of a C Corp or an LLC taxed as a C Corp. You may not realize this, but if you qualify for small business stock under 1202, which means it's less than, there's thresholds of how many people, usually less than 5, and how much money it could have in it, usually less than 5 million. And if you meet those requirements, you can avoid taxation when you sell the company. So if you're going to open up a company, you could literally avoid tax on, I think it starts at 10 million and then it could be a multiple of whatever the basis is, but you could avoid tax on $10 million. So if I start a business with 100 grand, for example, me and my wife, and we set up the Pizza Emporium and we sell it 10 years later for $1 million, my tax on that would be 0 because it is a C Corp or an LLC taxed as a C Corp. That's pretty huge. But just from a federal tax standpoint, on an annual basis, I'm filing a tax return called an 1120. That's all you got to remember. LLC, you file a tax return depending on how it's elected to be taxed. If it's disregarded, whoever the owner is. If it's partnership, it's a 1065. If that LLC is taxed as an S Corp, it's an 1120S. If that LLC is taxed as a corporation, it's an 1120. S corporations, they file only one type of tax return, an 1120S. C corporations, they file only one type of tax return, an 1120. There we go. You just learned, you get your CPA designation. Just kidding. Asset protection. This is probably the biggest issue, by the way, of the differences. This is a huge one. And I don't say this mildly, but the states have chosen to give lots and lots of protections to LLCs that they don't give to corporations, except for one state. And I'll tell you what that is. Number one, there's two types of liability. There's liabilities of the business itself that occur inside the business. So for example, whether I'm an LLC or a corporation, S or C, if I set up a box, an entity, and have a pizza shop inside it, and somebody gets injured in the pizza shop, it's inside liability. They're all treated the same, whether it's an LLC, corporation, S corporation, C corp, it does not matter. They're all identical. Outside liability, however, which means, hey, I get into a car accident and somebody sues me and wants to take away my pizza shop, LLCs are like 100 times better than corporations everywhere in the country except Nevada. And I'm not like, Nevada is literally the only state in the union that has statutory protections for shareholders of corporations. Otherwise, they can take your shares. So let me just spell this out for you guys. S corporations, the creditors of shareholders can take the shares away in all the states but Nevada. They could foreclose on those shares, they could sell them, they could liquidate the company, they could get control of the company and distribute all of its assets. That's what lawyers do. So if they're coming after somebody and they own a business and it's in an unprotected state or in the wrong type of entity, they can take those shares, get control of the company, sell all the assets, give themselves the cash as the creditor. Same thing with C corporations. The creditors of shareholders can take the shares of shareholders in all of the states except Nevada. The easiest way to think about this is if somebody sued you and they wanted to take your Microsoft shares, right? That Microsoft is a C Corp. They can foreclose and take your shares. If I am an LLC taxed as a C Corp in a state like Wyoming, they cannot take your shares away. There are so many more protections from that LLC than from a C Corp or an S Corp. What if I have a bunch of C Corps and I own shares? Then I'm going to say, set up a Wyoming LLC and transfer your C Corporation shares into the name of the LLC. Why would I do that? Because if I get personal liability, now I have outside protection. And that's how you accomplish it. Plus, I can make it invisible and I can make it really difficult for somebody to take my assets. But those are the biggest differences between LLCs, S corporations, and C Corps, at least the ones that will start the conversation, because it always depends on what you're doing, what your goals are, and where that activity is actually taking place. which jurisdictions we can use. Click on the link here if you want to talk to an expert who will make sure that you make the best choice for your situation. Because remember, about 70% of businesses are currently set up wrong. Let's make sure you are not part of that 70%. Please like and subscribe. Share this with anybody that you think would benefit. And if you have comments, please leave them. I do read them and I do answer them. And if you want me to make a video on a particular topic, put it below.